Portfolio winners and losers, latest closed trade cycle. Monthly post update 2 of 3. Updated the 14th of July 2026. Cosmic Algorithm Limited. Backseat Trader. Latest cycle overview. The latest dashboard covers the period from 6 June to the 6th of July 2026. It shows a start value of $25,318.14, money in of $259.97, money out of $250, realized profit and loss of $37.95, and an end value of $25,371.60. The headline result was modest, but the spread between individual trade outcomes was wide. That is an important reminder that the strategy is judged at portfolio level, rather than by whether every individual position produces a profit. Top 5 closed positions. The 5 strongest closed positions were: Applied Materials, ticker AMAT, up 25.77%. Palo Alto Networks, ticker PANW, up 23.18%. KLAC Corporation, ticker KLAC, up 23.08%. Lam Research, ticker LRCX, up 10.79%. And Intel, ticker INTC, up 10.26%. Bottom 5 closed positions. The 5 weakest closed positions were: Qualcomm, ticker QCOM, down 25.29%. Atlassian, ticker TEAM, down 16.80%. ARM Holdings, ticker ARM, down 15.14%. Marvell Technology, ticker MRVL, down 13.89%. And Cisco Systems, ticker CSCO, down 11.04%. The spread between winners and losers was substantial. Semiconductor equipment and selected cybersecurity exposure produced the strongest gains, while several technology and communications names reversed sharply. The lesson is not that the model should avoid losers entirely. It is that weaker relative strength must be allowed to fall out of the portfolio as rankings update. Nasdaq 100 market context, last 28 days. The recent portfolio pullback has coincided with higher volatility across the artificial intelligence and semiconductor complex. On the 23rd of June, the Philadelphia Semiconductor Index fell sharply as investors questioned debt-funded artificial intelligence spending and the possibility of a more hawkish Federal Reserve. Chip volatility remained elevated into late June and early July. Semiconductor shares came under renewed pressure, hedge funds reduced hardware exposure, and the Nasdaq also experienced another sharp decline as Micron and other chipmakers weakened on renewed concerns about the durability of the artificial intelligence trade. The picture has not been one way. There have also been strong rebounds in chip stocks, while broader prospects for the second half of the year remain closely tied to artificial intelligence spending, corporate earnings and interest rates. For a momentum portfolio concentrated in semiconductors, memory, storage, cybersecurity and artificial intelligence infrastructure, that combination can produce abrupt drawdowns even while the longer-term trend remains constructive. June to July portfolio rotation. The July rebalance retained 16 of the 20 names held in June. Those retained were Applied Materials, AMD, ARM Holdings, ASML, CrowdStrike, Cisco Systems, Datadog, Fortinet, Intel, KLAC Corporation, Lam Research, Marvell Technology, Micron Technology, Palo Alto Networks, Seagate Technology, and Western Digital. 4 positions exited the portfolio: AppLovin, Cadence Design Systems, Qualcomm, and Atlassian. They were replaced by Axon Enterprise, Microchip Technology, Monster Beverage, and Texas Instruments. This was a measured rotation rather than a wholesale reset. Core semiconductor, memory, storage and cybersecurity exposure was retained, while weaker June constituents were replaced by new names showing stronger relative momentum. Notably, 3 of the 4 exits, Qualcomm, Atlassian and AppLovin, were among the weaker closed positions in the latest cycle. That reinforces the logic of a rules-based process that removes deteriorating leadership without discretionary override. Outlook for the months ahead. The constructive case is that artificial intelligence infrastructure spending, semiconductor demand, memory recovery and data center investment continued to support leading technology stocks. The risk case is that high valuations, crowded positioning, Slower capital spending, earnings disappointment or higher for longer interest rates trigger further sharp rotations. The next major test is earnings. For this strategy, the practical response remains unchanged. Do not forecast. Do not chase. Do not override the model. Continue to rank, rotate and rebalance according to relative strength and risk behavior. Key takeaway. The latest cycle shows why performance must be read beside process and risk. Strong gains in Applied Materials, Palo Alto Networks and KLA Corporation coexisted with sharp losses in Qualcomm, Atlassian, and ARM Holdings. The portfolio rotation then replaced 4 weaker names while retaining most of the existing structure. That is the discipline being tested during the recent Nasdaq 100 pullback. The question is not whether volatility can be eliminated. It is whether the strategy continues to adapt without emotion as leadership changes. Past performance is not indicative of future results. Investing involves risk, including possible loss of capital.